So let's get started. Normally, we just look at the live markets and apply our rule-based supply-demand strategy. Specifically, the goal of what we do is to apply the supply-demand rules that we go over and identify where banks and institutions are buying and selling in the Forex markets. To do this, we identify the picture that represents bank or institutional demand and supply. For those that are new to the session, I'll give you a quick little bit of information. My name is Sam Seiden. I did not start out screen-based trading. I started out on the floor of the Chicago Mercantile Exchange, actually in the Forex, on the Forex floor upstairs years ago. And so that was my world in the beginning. We didn't look at charts or anything like that. But what I had in front of me, I facilitated orders for banks, institutions, money managers, hedge funds, and so on. And so what I did over that time is train my eye to see exactly what the picture of those orders looks like on a price chart. And that's typically what we go over here at FX Street in our session. Today, excellent FX. If you want to send that to me, that'd be great. By the way, let me just one second. There's my email address. It's actually an easier one. So if you send me any emails going forward, please send them here. sam@tradingacademy.com. FX, be great. Yeah, send me that trade. We'll see what you did. And if anybody has any questions, again, sam@tradingacademy.com. Okay. Aviator, yes, very objective. Everything is very rule-based. But send me an email. We could talk more about it. sam@tradingacademy.com. Now, let's dive into the topic here. So I could tell you, having the orders in front of me on an exchange floor from some of the biggest banks and institutions around the world, I could tell you where the markets were going to turn, the yen, the pound, you name it. I could tell you where prices were going to turn and where prices were going to go. Going on to charts, translating that information onto charts. That's normally what I go over with you here at FX Street. But I can tell you, it was probably 8 months to a year into my career down there before I ever even knew about charts or technical analysis, this thing called technical analysis. Okay? Flow trader, yeah, that's exactly our topic today, and I'm getting into that now. I just want to kind of tell you kind of how this came about. So I can tell you, we really focus on picking turning points here, getting in when the trade is low risk, high reward, high probability. But I can tell you about 8 months into it, in my career down there, I was walking to lunch with someone, and this guy, and he says, I think the S&P is going up tomorrow. And I'm like, okay, why do you think that? He was actually, and he starts telling me some things, and he says, because, this is doing that, and the MACD is doing this, and we were on our way to lunch, and I'd never heard of anything he was saying before. So when he says MACD and we're going to lunch, I'm thinking McDonald's, getting more hungry. So I started asking him, I'm like, I don't know what you're talking about. And he says, technical analysis. I'm like, no, I don't know technical analysis. I don't know what you're talking about. So he starts telling me about this stuff, right? And, of course, I know all that stuff now. But a few days later, he takes me to the CME library. There's a small library at America back then. And so he shows me this book on technical analysis. And I started flipping through it. He's explaining some things to me. This was many years ago. And so we got to the kind of the charting section with all the chart patterns. I'm looking, I'm like, man, every one of these, has you buying, every one of these chart patterns, cup and handle and shoulders, double tops, double bottoms, any of them, they all have you buying after such a big move up in price. And they all have you selling after such a big decline in price. I'm like, who uses this? I'm asking him, like, does anybody use this? And he says, well, yeah, that's kind of what everybody does. I'm like, well, this doesn't make any sense. I mean, I'm used to buying low, selling high, and selling high and buying low, That's how I was taught to do it. And then we get to the section on indicators and stuff and all that. And again, it was the same issue. It's like you're always buying after a rally and selling after a decline in price. And I asked him, I'm like, everybody uses this? He's like, yeah. I'm like, does anybody make money with it? He's like, well, I don't know, And anyway, I haven't talked to him in years. But another section that jumped out at me in there, there was a section titled, I think it was called Dow Theory, or I think that way back then, and it was about trends. And I looked at the trend section, and since then I've looked in, trend sections, and like, I've seen, you see the trends, how trends are identified and taught in every trading book ever written is always the same. It's make sure for an uptrend that there's a series of higher highs and higher lows, right? And you tell me, I mean, you've read the books, how many higher highs and higher lows do you have to have before an uptrend? Anybody? I mean, what's the rule? Is it 2? Is it 3? I've kind of seen it both ways, but I'm curious to what the consensus is. 3. So, okay, so you guys are saying 3. So 3 higher highs and 3 higher lows, and then you have an uptrend. Okay. So some people are saying 2. All right, so maybe it's 2, maybe it's 3. But either way, you have to have 2 to 3 higher highs and 2 to 3 higher lows, and then you have an uptrend. And then we're all taught, according to the books, that now it's okay to buy. Now it's time to buy, right? Okay? But let me ask you, what has to happen, okay, what has to happen for you to get those higher highs and higher lows, right? What has to happen? What have a lot of people already done before you get those higher highs and higher lows? Yeah, a lot of people have to buy already. But think about it. That picture of higher highs and higher lows is an invitation that goes out to the masses that have read all the trading books and taken all the trading classes that says, look, now you have this picture. Now's your invitation. Now come in and buy into this market, right? Okay. But my question to you is, since a lot of people have to buy to create that picture of higher highs and higher lows, why do the people who buy to create that picture, why does it always have to be somebody else? Why can't it be you? Have you ever thought about that? Have you ever thought, boy, it would be nice if I was in this market, when this picture is created, because now everybody that identifies with this picture is going to come in and buy. You see what I'm saying? Yeah, Pip Runner's saying greater fool theory. Exactly. Okay. Well, it doesn't have to be somebody else. It can be you. And if you've been following the supply-demand strategy we've been going over here, you can see that often it is you. So I want to take a little deeper dive into specifically the trend portion of this, because we never really talk about that. And it won't take long. We'll get into the live markets in a moment. But I want to use our time wisely here. And again, my whole point is that picture that creates that uptrend or downtrend that tells you it's now okay to get into a market, it doesn't have to be somebody else all the time. It can be you, all right? In other words, you don't have to keep paying all those people and rewarding all those people that got in before you. You can start getting rewarded. You can start getting paid. All right, so again, kind of to sum that up again, conventional technical analysis tells you the trend way after it's underway, of course, okay? All right. Yeah, and the getting in early is great. That's exactly what we want to do. We just want to get in at the right time, right? Okay, and that's the whole point of the levels. All right. It's always good to get in early, but I think that what you're kind of saying there is, you need to get in at the right area. You need to know, because every downtrend ends, okay, at a demand level, and every uptrend begins at a demand level. Conversely, every uptrend ends and downtrend begins at a supply level, but a fresh supply level. Okay. All right. So let's move on here. So take a look. Here's just and I want to go over 3 quick pages with you here. All right. And this is just kind of something you kind of keep in your head, and then we'll go to the live markets, and I'll take this quite a bit deeper. All right. So, how do we identify trend in real time? Right. So take a look. Instead of higher highs, higher lows, lower highs, lower lows, moving averages, all that stuff. Okay. Notice here. Now we're going to look at real charts after this. So prices are trading sideways. All of a sudden there was a drop in price, right? This white candle here. So while prices are moving sideways here, there's no reason to guess whether you're going to get a breakout to the upside or breakout to the downside. Just understand that once prices drop as they do here, okay, that tells us objectively, without thinking, we are in a downtrend. There's no reason to buy. Okay? All right? No reason to buy. We're in a downtrend. Down here, you get another base. Again, you get another decline out of this area. Okay, that tells us whatever market we're in, we are still at price levels where willing supply exceeds willing demand, which means in real time, there's no reason to buy because we are real time in a downtrend. Right? Okay. Down at the bottom, we get another series of basing, but at this time, instead of declining, we get our first rally. Right? Okay. Once you get this rally, think about it. That tells you objectively, okay, it tells you objectively that you finally reached a price level where willing demand exceeds willing supply. Okay, that's the only thing that can cause a rally in price here. Okay, so therefore we want to buy that first pullback. That's again what we focus on here in the sessions. All right, but by the time you get higher highs and higher lows, you're so late to the party. It's not even. I don't know how you'd ever make money doing that. Okay. All right. All right. So let's keep going here. Let me go to the next page. Just a second. All right. I'm just kind of reading back here, making sure I don't miss too much. Just reading back here. Yeah. So great question there. Who wrote that question? Treasure Beach. Yeah. Boy, two great things there, a treasure and a beach. Perfect. Anyway, just your question, yeah, a little off topic, but I'll hit it because it's very important. How prices leave a level tells you almost exactly how they're going to come back to a level. So if you have a level that's created with kind of this grinding pattern to the upside, kind of stair-step pattern to the upside, be assured you're almost always going to get that same stair-step pattern down. Remember, every level, we don't talk about this enough, but every level, okay, is created because of another level's existence. But you'll see, Treasure Beach, that, every time you get a strong rally, strong move away from a level, it's almost always a strong crash right back into that level. Small time frames, bigger time frames, same thing, okay? All right, so take a look. So prices are trading sideways here. This is a real chart of what we looked at. Drop in price. In real time, you're in a downtrend. We're at price levels where supply exceeds demand. No reason to buy. You can certainly short the rally here. This is our setup with selling at supply, right? Same thing here. Prices are trading sideways. Drop in price. Okay. Again, in real time, we're still at price levels where supply exceeds demand. Real-time downtrend. Same thing here at this level. We can certainly short this rally back to this level. Okay. And down here again. But here, for the first time, now when prices are basing here after all this, you're probably going to think, you know what, we're just going to drop again. But the key thing here is don't think. Okay? Don't think. Yeah, if there's no congestion for being, you're going to get no congestion on the arrival, almost always. But so here, instead of getting another decline, we get our first rally with this green bar. That tells us objectively that we've now reached price levels in this market, whatever market it is, where demand exceeds supply. Therefore, we want to buy the first pullback into this area. Okay? This is how we caught the 2009 low in the stock markets. This is how we caught the high this year, I believe, on March 3rd. Is that March or April 3rd? March 3rd or April 3rd? I have to look, but we had it all in our we have it on slides in our things. It's because you get your first big move away, and we just natural gas on the bottom. You just had your first explosive move up instead of another drop out of a base. We were able to get in on the first pullback. Okay, same thing. So we want to get in here before the obvious conventional trend is underway. By the time you get a series of higher highs and higher lows, again, the trade, it's so far after the fact. Your risk is enormous. Your reward is tiny. Anyway, I think you get the point. Okay. One other thing here I want to go over before we get to the live charts. Okay. Yeah, Brad, it's funny because when natural gas was trading in the 20s, I heard people saying it was going to 50. And as soon as that happened, then it almost became free, right? So it's funny. That's like what did someone say? Apple to 1,000. That was about it there. But You look at the supply levels on Apple on the 60-minute chart. I could put them in a manual. They're perfect, right? Okay. So take a look here. There's one other way that people conventionally, in conventional terms, quantify trends, and I want to go over this just so you can be careful. All right. Again, I have no ties to any brokerage firm or anything. My only goal is that you understand this and you're successful. So take a look, and it has to do with moving averages. All right. Notice here we have here's a cluster of trading and a strong rally out of that level. Another base, strong rally. Two demand levels that would score out fairly high when you look at the OTA odds enhancers that we go over. But take a look. When price comes back into this level, the 20-period moving average, just like just about any other moving average, is sloping down. And most people think, well, you never buy into a market when a moving average is sloping down. Well, guess what? Every single one of our trades that we take, longs and shorts, right? Every time we buy into a market, almost all moving averages are going to be pointing down. Okay. Almost every time, I will say, every time we sell into a market, sell short, right? If you remember some of those Euro trades we've had recently, all the moving averages are pointing up. They have to be. Remember, how you make money buying and selling in markets when you trade, short-term or long-term, is exactly how you make money buying and selling anything else. Okay. Over here, not only is, when price comes into our key demand level where we want to buy right here with our stop just below, okay. Yeah, good point there, FX. Absolutely. They're great when they're in the right place. And again, that all has to do with the odds enhancers. So when we're ready to buy right here, not only is the 20-period moving average sloping down, price is below the 200 moving average. And if this market is the Euro or the S&P, what are they going to be saying all day long on TV? They're going to, it's be like news alerts, breaking news. Do not buy into the S&P because it's now below the 200-day moving average. Well, what if you walked in your favorite store, and there was a sign right there that said your favorite item that you came to buy that day was on sale for half price, and there's only 5 left, and they're in the back of the store. Are you going to leave and because not a good idea to buy them? No, you're going to run and buy as many as you can. You see what I'm saying? It's the same thing. Okay. No, we are just buying strictly off of price. What the candle picture or pattern is irrelevant. Okay, that's just a function of time frame. Okay, and I don't even know what moving averages are. It doesn't even matter. Simple exponential. I don't use moving averages. I've never used them because all they are is an average of prior prices, which does me no good as a trader. They don't know where the banks and institutions are buying and selling. So I don't want to spend time with them. All right, let's go to the live markets. And give me just a moment here. We'll get those up for you. All right, so you should be able to see 6 charts, 5 of which are the Euro. Can you see that? Trying trader, so buying pullbacks to a moving average, I would never do that unless that moving average lines up. If you're going to do that, make sure that the moving average lines up with real supply and demand. You know what I'm saying? Like sometimes you'll come across people that want to use Fibonacci retracement levels. They'll say, okay, they can't make them work, right? They're struggling making them work. So, but they really want to use them. So say, okay, put all your 5 line Fibonacci retracement levels on the chart, and then look to the left, and whichever ones line up with real supply and demand, not support resistance, but real supply and demand, take that line or those lines. And over time, what you're going to find is, if I'm only taking the Fibonacci retracement lines that also line up with real supply and demand, then why do I need the Fibonacci levels? You see what I'm saying? Okay. All right. Okay. Let's see. Let's go over the Euro here. So the Euro, I think a good chart to look at the moment is this 240-minute chart. I had a couple levels in here earlier. Let me just clean this up a touch for you, and we'll go over it. And let's get a little deeper into the levels here. Okay, I'm going to focus on the first thing we always want to do is quantify where current price is in relation to larger time frame supply and demand. Okay, so let's take a look at this chart. All right. So above current price, we see prices falling quite a bit here. According to the chart, we don't have any significant fresh, keyword fresh, demand on this time frame until quite a bit lower, just below the 127 mark. Right here. Sorry about that. All right, so this comes in at 126, call it 126.70 to 126.50. So 20 ticks here. But again, pips, this is a 240-minute chart, very big time frame. There'll be other levels we could find on the smaller time frames, but let's first, we want to know where we're at on the larger time frame supply-demand curve. For this purpose, okay, we want to know whether we should be looking for longs or shorts, right? Which side has the odds right now, the longs or the shorts? Well, we're kind of in the middle or a little below the middle. So we can look for both longs and shorts on the smaller time frames. But the closer we get to this larger time frame demand, the more we want to be exiting, shorts and getting ready to buy. And obviously the closer we get to the larger time frame supply, we want to be, easy on the longs and get ready to sell short. Okay, it's very objective. If we were anywhere near this larger time frame demand, we could still take small time frame shorts, but we'd have to be very aggressive on profit taking. Probably never more than 2 to 1. Okay. Yeah. So some people are looking at this level right here. This is a pivot low. This is a conventional textbook support or resistance level. Again, for those that are new to this session, we don't buy into the school of thought around support and resistance. The reason why you don't hear me use the word support resistance is because I know that everybody here has a different definition of support and resistance. Okay, meaning to one person, support resistance is a Fibonacci retracement level. To someone else, it's a pivot high or low. To another person, it's an Elliott wave point, or another person, it's a moving average. I could go on, but everybody has a different definition of support and resistance. So instead of reinforcing something that's not accurate, let's zone in to where the banks are buying and selling. What is the picture that represents that? Make sense? Okay. So with our odds enhancers, we can see that above current price, here is I just got this little security alert on my computer, so I'm going to try to exit this out. Hopefully nothing happens. All right, good. Nothing happened. Sometimes you click those and your whole computer shuts off. So here's and I always kind of walk that fine line of going over as much as we possibly can without going too deep into what we do in the XLT, just because it's not fair to XLT members. And but again, I try to do my best with that. But here's something that I think is really key in the XLT that can really help you. So we don't cut through candles. All right, we do not cut through candles. All right, so that's a key thing there. Meaning, when we're finding supply, let me show you how we do this. We start with current price. This is a big thing. This is a big reason why we're so accurate. We start with current price. We go up the price ladder. Watch my arrow, and left. See, I keep going left until we find the picture that represents supply according to the odds enhancers. All right. Odds enhancer number 1. Look at how prices left this level. Strong decline in price, even with a gap, which we hardly ever see in the spot Forex market. Number 1. Number 2, very little time at the level. Okay? Very little time at the level. That's key. That tells us there's banks selling euros here aggressively. Okay? So if and when prices come back up to this level, and I know it seems like this level's far away now, the prices were here less than a week ago. Okay? So this is our large time frame supply. Conversely, I would say the same exact things about this demand level. Only difference, there's no gap out of there, but that's okay. It was a nice strong move away. And Treasure Beach, you were asking before, should you place a buy order here? What if prices don't come back the right way? Well, focus on how they left the level. If there's no demand in here, inside these green candles over on the left, you're probably going to see price just cruise right through that level. So I expect price to, come crashing down into there. We've got the little bit of demand in here to deal with, but not too much. Okay. All right. So now that we know where we're at in the larger time frame, let's go to the smaller time frame. Give me just a moment here, and we'll do that. So I'm just going to, I guess we can go to, let me pull up this chart here. And I'm going to grab it for you. All right, there you go. There's in Treasure Beach, there's my email address again, sam@tradingacademy.com. If you want to send a screenshot, if you have a question, certainly send it there. We'll get that question answered. Okay. Philippe, do market profile charts help identify supply and demand? They can help, but you have to be careful that there's the conventional school of market profile. But be careful with that. There's some major flaws with that school of thought using market profile as is, like from a conventional standpoint. I'll give you the biggest flaw right here, just to, because I want to save you some time. If I didn't reply to an email, just send it to that email. Yeah, sorry about that. Yeah, so one of the big flaws with just this conventional school of thought and market profile is that they give each area equal weight. Okay, each cluster of trading, each level they find, they kind of give it equal weight. Well, that ignores, supply demand 101. See what I'm saying? So be careful with that. But there are better ways to use it. All right, so let's take a look at this chart. Let's first identify supply on the upside. Okay, and here we go. So we've got a level sitting just up here prior to the most recent drop. Okay. Now, I'm not going to take this whole level. I want to know, everybody's focused on, we'll take a little deeper dive in the whole supply-demand concept. Obviously, in real time, we are in a downtrend. The last pattern we had on our chart was a supply level, which means in real time we are in a downtrend. Okay. This downtrend will continue until we reach a price level where you have equal or greater demand, which is going to show up as a demand zone on that larger time frame. Make sense? Boyke, no, not at all. Believe me, not at all. Couldn't be happier being able to do this on the screen. Okay. Yeah. So Praveen, to your volume question there, let me, kind of what I'm about to explain is right in line with what you're saying. Everybody's taught, especially reading the trading books, we're all taught and conditioned to focus on the candles. And the red and green candles, whatever color candle colors you have. But I want to kind of just broaden your thought process here a little bit. Candles represent what? Remember, we just got to keep things real and speak to what we know to be true. Candles represent trades that have happened. Right? They represent trades that have happened. That's how you get a candle on your chart. But what moves price? Is it trades that have happened or trades that have not happened yet? In other words, what exactly is responsible for moving price and turning price? Is it filled orders or unfilled orders? Okay. All right. It may sound like a subtle point, but it's really big. It's not filled orders. It's unfilled orders. Unfilled orders move price. Filled orders, they're filled. You see the candle on the chart. It's all the unfilled orders that move the market. All right? Makes sense? So when I'm looking at this area here, if I'm going to make a supply level out of this, okay, I see, I'm just going to draw a lot. This is a very ugly area here, but according to our XLT rules, we would draw our lines right here for the supply. And I'm going to draw two levels in here. The upper one is according to the odds enhancers, is better than the lower one. But let's draw both of them in. And let me just put these in. Just a sec, then I'll grab the chart again. All right, let me just grab the picture, take a picture. Yeah, stop losses, yeah, but those are unfilled orders. And those are definitely included 100%, okay? All right. Yeah, Maurice, that's definitely beyond what we're talking about today. That's a big big thing there, okay? You know, it's not like anybody controls any markets. I mean, look at I trade the 10-year note, you know, futures sometimes along with many other markets, but you know, the Fed is very active in those markets, big bond markets. They print money and they can't even control the markets, right? So don't worry about that. Yeah, Boyke, and when you're trading, absolutely you should have profits, losses, and one should not affect you any more than the other. Absolutely. And that's the beauty of trading. You know, if you're doing it the right way, you know, like we always focus here in our setups, make sure that, in other words, here price moves away at least 2 to 3 times the size of the distance from entry to stop. The reason we do that is, you know, then you can be wrong half the time. You can have half your trades can be losses. You should still be able to make money. Now we don't want that, and that's not acceptable. But you can. Okay, every trade does not have to be a winner. Right? Absolutely. Yeah, great. Thomas is mentioning Trading in the Zone. There's another book, Market Wizards. There's a couple Market Wizards books. Okay, you ever read those books? I never read all of them, but I know a lot about some of the guys in there. And if you think about it, I mean, a lot of those guys were wrong, wrong more than they were right. But because of the risk reward, they they're considered some of the best traders ever. All right. Anyway, here's some supply. So we start our line right here with our top line here. Now in this area, we see that price was able to go up into this area and then get slammed down, meaning there's lots of unfilled orders in here, and obviously the most filled orders are in this white space. Okay. Unfilled orders, Connie, that's like potential and kinetic energy. Not that I'm a scientist or anything. You know what I'm saying? It's like, you follow me? You know, the unfilled orders. In other words, why did prices drop from this level, Connie? It's only because you have too much supply here. You had more willing supply than there was available demand, meaning unfilled orders. So prices dropped. Now, the better level is this area right up here at the origin of this drop. Okay, and I'm going to kind of combine a couple little areas here. All right. And we're going to go with this right there. Yeah, and actually, Philippe, it's the exact, how and why, if you really want to quantify how and why prices move always, it's the same mathematical equation as that potential kinetic energy. Same thing. We could be talking about, how an earthquake happens, right? Two big plates of earth, push against each other until this threshold is met where you have an earthquake, right? That equation, it's underneath the governing dynamic, it's all the same mathematical equation, whether we're talking about earthquakes, energy, price and markets, it's the same exact energy behind the scene, same exact equation behind the scenes. All right, yeah. So here's a better area. You had much less trading here. This is not a pivot high or anything like that. Strong drop away from that level. So we'll watch for this 128.40 to 128.47, and I would put a stop no greater than 5 pips above that. And I don't even know that we need that much. So that would be at 52. I would be looking for 3 to 1 out of that opportunity. Okay. So let me put this right there. Take another picture. Now, why 3 to 1 for this top one? You might be thinking, well, that's like a great level. I can hold on to this forever. It could certainly go further, further than 3 to 1. But remember, if and when price comes back to this lower level, for it to reach this 128.40, you're going to have to chew through all this supply up here, which means, by definition, if and when price gets up to this 128.40, you will be left with a demand zone at 128. Okay, you're going to have a fresh demand zone at 128 if you get up to here. All right, does everybody understand that? Okay. I mean, I'm like, 99.9% of the time, if you reach this, you're going to have a fresh demand zone at 128. That's the picture that you're going to have by the time you absorb all these orders. So 3 to 1 gets you out somewhere down here before you get the demand, right? Nils, you can recheck it, but I don't know that you need to. Okay. All right. All right. Sounds good. Let's see. FX, I'd have to look back. But it's probably about. I'd have to look back. But I'd say it's probably about 70-30 on the win side. I am testing. I'm many months into testing this automated strategy. I can. Well, I was going to bring it up here. I have it on another page, but that would add a whole other set of conversations. But anyway, so with that, it's been the profits are strong, but the win-loss could be a little better. So anyway, it's there you go. All right, let's see. Yeah, living daylight. I love momentum trading. Momentum traders. Two things. Momentum traders are going to buy after price is moving already. So once price turns from our levels and starts cruising, that's when momentum traders come in. So that's what you want. I mean, the only way you're going to make you want people to buy after you bought and sell after you sell. So you don't want to. I don't know that you want to do the momentum trading, but you certainly want everybody else doing it. And also too, when you say plows through supply demand zones, we would have to make sure. I would say momentum is strong. It does not plow through supply demand zones. It all depends on your definition of supply and demand. Okay. And I can think, we've got so many examples now. Let me get back to the chart here, but yeah, you have to make sure that your definition of supply and demand is proper and meets the definition that we go over in here. Okay. Give me just a moment here. Okay. Let me grab you another chart. So just a moment here. So those are a couple levels in the euro to potentially take advantage of. Well, I wasn't going to bring this up, but I saw a couple questions, and it made me think of this trade we just. This is a picture of a trade we took recently in the Forex XLT. A lot of people ask about XLT. Here it is. Your name is here. This is where you're interacting with us, and here's where you're seeing the instructor trade. If it's me, we have three other Forex instructors as well. It's all live markets, live trading. But take a look at this. This is a trade we took. Very small time frame. Now this was taken in the futures, so not the euro futures, not the spot. Okay. I don't know if you'd be able to on such a small time frame get an order like this off the spot. Maybe. But in the very small time frames, when we're very short-term trading the Forex markets, we'd like to do that in the futures. Swing and longer term, I think you're fine with the spot. Anyway, identified this strong move from this little area right here. Okay, and when price came kind of crashing down into that, we're able to buy here because notice this high right here absorbed all the supply over to the left. And just so you know, what caused this was there was nothing over here to the left. So we saw that we had been up to supply once here, again up here, and we've eaten up all the supply. Now we want to buy against any demand because we know that there's no supply until significantly higher. Make sense? Again, that's not to say every trade is a winner and every trade makes that much money that fast. But this is an example I have here. I have some other examples. Let me show you These are all examples. Here's a trade that I took. Okay. So yeah, and when shorting up here it's supply, but notice, I want to point something out to you. Notice, didn't take anything in here. Okay, would not take this as supply. Would only take this as supply. All right. Now, when price came up here, one of three things is going to happen. It's either going to stop and turn before this, so you're not going to get filled. It may go up and eventually, go through it. And you get stopped out for a small loss, or it's going to turn and you hit your profit target. But what you want to see, the main point on this one, is notice the rally into the level. Okay, it's just a 5-minute chart, but notice a strong momentum move. Reason why I brought this one up is because that momentum. Someone talked about momentum in the chat here at FX Street, and this picture, this strong momentum move up into the level. Not only do we not try to avoid that, but that's actually what we're looking for. I want to see a strong momentum move into a level. The key thing is you need to know how to identify levels, right? That's everything. Notice this example. And before you ask you a bunch of questions here, let me explain, because this one's gonna cause you to want to ask questions, so I'll explain. In this example, this is a real trade we took. We bought right here on this momentum move down, which we like, into a key demand level that scored out very high with the odds enhancers. But before you start doing this, I think you need to know that the difference between this level and all these, we would never even call these demand levels. Again, it all comes down to those odds enhancers. To me, these are not demand levels to buy against, where this one is a very key demand level to buy against. Now, I've shown this in the newsletter, Blue, exactly. So let me explain, give you a couple of the odds enhancers that would disqualify these levels. First of all, you can pick any of them. I guess we'll just start with the top one. Here's a base and a rally. Here's a base and a rally. Almost look identical. Well, the reason why this would never even be qualified to call demand is because, let's say we drew a line across here. Okay, we would never buy here because look what's sitting right above. Supply. So the odds enhancer called profit margin or profit zone would disqualify this as a demand level. Okay. This one as well. Same thing there. Okay. This one looks almost identical to this. Base rally, base rally. Why not buy a pullback to here? Because supply is too close. There's no profit margin there. And as I said, when you're rallying with these, this stair-step pattern, you're almost always going to decline with the same thing. But here's the difference. When price comes, first of all, there's other things that may, other odds enhancers that made this a good demand level. But look at when prices came back. Remember, a key thing I told you today, we don't cut through candles. Yeah, this one's a very fresh level. But so when price came down to this level, right, look inside these red candles here. These are the only candles that matter when price came back to here. This is all irrelevant data at the point of entry here. There can't be any buy or sell orders left because of these candles. It's impossible. So all that matters right here is where was the supply in here, and is there anything inside these red candles to stop a rally? No. Okay? We love when price crashes down like this. All right? It's like a quick for a few minutes, things are on sale, you got to scoop them up, be happy, and off you go. Okay? And price could have, stop this out here for a small loss. That's okay. Small loss is fine. But if you're scoring out the odds enhancers the right and picking the right levels, that's the key to doing this. So you might say, well, here's a demand level, but price crashed right through it. Well, your definition of demand may be very different from what we're talking about here. So I say all these things to make sure that you understand what you're getting into, and definitely no one's pushing you to just trade. Be careful. You need to know, again, what that picture looks like. It represents banking institution demand and supply. That's normally what we go over here. I wanted to go over that with you today, and hopefully that you got that. And also the trend stuff. That's key. If you're really focused on trend, be careful using conventional trend analysis as an invitation to get into the market. Okay. I wanted to, yeah, those bull and bear traps are great. There's my email address again, sam@tradingacademy.com. Again, sam@tradingacademy.com. George, yeah, we've been pretty bearish on gold. Any fresh supply levels above, we're selling those. Okay. Great, Janetta. Yeah, send me that. It'd be great to see it. Again, there's that email, sam@tradingacademy.com. All right, well, hopefully that was helpful, folks. And again, I'm just here to help you. So let me know what I can do, and send me an email if you want to that new email address, sam@tradingacademy.com. Have a great day. Good to see everybody again. Boyke, everybody. Quite a few years, Boyke. I'd have to count. I don't know, 4, 5, 6. It's been a long time. All right, have a great day, everybody. Thanks again for your time.